All right, so first we have Jason. Jason, if you give a little wave, they know who you are, perfect. Jason has 22 years of experience providing accounting and tax services to a variety of clients in the manufacturing, construction, professional, and not-for-profit industries. Jason is a certified financial planner and offers financial strategies for BDO clients. Jason is an active member of the community, serving as the treasurer for Employment Planning Council in Peterborough and past president of the Kinsman Club of Peterborough. Within the last couple of years, he has also been the chair of the Greater Peterborough Chamber of Commerce and treasurer of the Greater Peterborough Health Services Foundation. Please welcome Jason. Yay. Next up, we have Katie. Okay, Katie has 4 years of experience providing audit and accounting services to a variety of clients, including public sector, private sector, and not-for-profits. As an audit and accounting manager, she is responsible for managing many of the office's audit and review engagements, along with supervision and training of staff and detailed file reviews. Katie is an active member of the community, serving as treasurer of the Lindsay Curling Club, and is an active member of the club. Please welcome Katie. All right, so I'm going to pass it over to them to get started with their presentation this morning. And again, we have time for questions at the end, so feel free, you can put them in the chat or we can unmute ourselves and go about it that way. Okay, thanks guys.
Okay, great, thank you. Welcome everybody. I was going to say good morning, but I understand that it may not be morning where you are. So we are going to go through the importance of cash flow projections and the basic mechanics of preparing them and why we prepare them. It's not the most interesting task, and it's certainly not the one that's going to create the most satisfaction, but it is a very important task in managing and running your business. So we're going to go through that. I think the next slide is a picture of Katie and I. We've already had our introduction, so I don't really have much to add to that. As mentioned, I've been in public practice for 22 years, and so have worked with our clients, assisting in preparing cash flow projections, managing cash flow projections, dealing with cash problems. And so we'll see it as we get into why we prepare cash flow projections, but really the better way to handle cash shortages is to know that they're coming and be prepared for them rather than be surprised. And that's going to be really the key piece of why you want to be on top of this. Katie's been with us in the Peterborough office. She's a manager and again works on the same type of clients. We actually both work on credit union clients, so we see the need for cash flow projections from the other side, being the banking industry, and that'll be another key reason why they get prepared. So without any further ado, let's dive in. And really, let's start at the start. What is a cash flow projection? And it's not overly complicated, but it is important to understand that what you're trying to accomplish when you prepare a cash flow projection is really a prediction of what, not necessarily what your revenues and expenses of your business are going to be, but what the cash flow is going to be, which is very similar. And when we get into it a little later, Katie's going to go through the mechanics of what constitutes a cash flow. But really what a projection is, it's a breakdown of the money that's expected to come in and out of your business. And really, if you think of it, preparing your cash flow projection is very similar to preparing your budget and balancing your checkbook at the same time. Unlike the budget, though, the cash flow projection doesn't deal with your revenue and expense, it deals with the cash flow. So tied to revenue expense, but also tied to the timing of when that money comes in and out. And really, the cash flow projection is intended to give your business and you, as the owners of your business and your business, a clear idea of what your cash needs are going to be over a period of time. And what that period of time is will really be specific to each business, but generally the recommendation is you you prepare a 2 to 3 year cash flow projection, more detailed in the initial year, and then at a higher level as you go out into years 2 and 3, and then continue to upgrade it and expand it into the future periods as time passes. So the next slide. Yeah, thank you, Katie. So the importance of cash flow projections. And again, I've touched on a number of these, but really the main thing to keep in mind, and there's been some studies done, cash flow it can be very unpredictable. And for most businesses and startups, it's new because you don't have the history. So it's very important at that stage. And the studies that I referred to, 60% of businesses that fail, it's because of cash flow problems. So it's often the main reason why a business will fail. So to avoid that, it's very important to manage your cash flows. And so cash flow projections they're one of the most powerful tools in cash management. They allow you to see when cash is coming in and when cash is leaving your business. And so then you can predict and plan for surpluses and deficits. And understanding and predicting this flow of money will help you to make important investing decisions. You can project, in the months to come, whether you're going to have a shortage of cash flow. And if that's the case, that's not particularly the month to go out and buy that new piece of equipment, unless it's absolutely needed, right? So it's putting all those pieces together. And you can also predict and manage when you're going to need outside cash. So, a tool that's often used to help manage cash flow are lines of credit. So if you kind of think, in a given year, you may have a positive cash flow, but there may be 2 or 3 times through that year where you have negative cash flow. And it's those times that you're really trying to predict and manage. And so if you know when that's going to be, rather than getting surprised by it, you can be prepared and have a line of credit or some other source of temporary cash support to get through that. And you can have that in place before you get into the crisis situation. As I mentioned, no cash flow projection is going to look the same for each company. Every company is unique, and every company's trend of revenue and expenses is going to be unique. So, they're always going to be different, but the building blocks and concepts are all really the same. And so with that, I'm going to turn it over to Katie, who's going to take us through those basic concepts and the mechanics of preparing a cash flow projection.
Thanks, Jason. So as Jason mentioned, I thought to get us started, we just kind of go through the basics of a cash flow projection. So in order to properly create a cash flow forecast, there are 2 concepts that we really have to master. And as Jason mentioned earlier, it's very dependent on our accounts receivable and our accounts payable. So receivables are essentially money that the business is expecting to collect. So this can include customer payments and deposits, but it could also include government grants or rebates. An example of that would be, say, an HST rebate owing to the company. On the other hand, payables refer to the exact opposite. So that's anything the business will need to spend money on. This could include payroll, taxes, payment to suppliers and vendors, rent, overhead, inventory, the list goes on and on. So a cash flow projection is essentially a breakdown of your expected receivables versus your expected payables. And it's an overview of how much cash the business is expected to have on hand at the end of the month. And so as Jason mentioned, it's not just revenue and expenses, because it depends on the timing of when that money comes in. So you could have a sale in, say, January, but you don't actually receive that cash from the customer until February. So it's very much a timing, a timing thing. So you have to be careful of knowing when that money comes in and when the money goes out. Okay, so just to kind of give you a quick overview, there's a lot of different types of cash flows, but just to kind of give you a few as some examples. So our cash inflows, this can include cash sales, sales of fixed assets, any interest that you earn on investments, government grants or grants from other organizations, loans from banks, or share capital invested in the company. On the other hand, we have cash outflows. So this could include payment to suppliers, wages and salaries, payments for fixed assets, interest on loans, repayment of loans, or dividends paid to shareholders. And of course, this is just to list a few for each. There's so many different types of inflows and outflows, but just to give you an idea. Okay, so next we're gonna kind of go through what a cash flow projection looks like. Now keep in mind this example we have up on the screen is very, very simple. The cash flow projection for your business would likely be a lot more detailed, and the more detailed it is, the better it is, and the better you kind of can analyze things month to month. But for this purpose, we just wanted to break it down really, really easily and show you kind of the high level picture of it. So a cash flow projection includes 12 months laid across the top of the chart. So again, as you can see, we only have 4 months here, but we would typically have the remaining year continue on. And then our first column here is our opening balance. This is our opening cash balance. So this is what you have in your bank or the cash that you have on hand. So below the opening balance, we have any of our cash that comes in. So essentially the sales or the money that you've received for sales, that's our cash in. And then we have our cash out. So this is any potential payable amounts. So we could have material expenses, marketing expenses, wages, and again, the list goes on, but just to kind of show you high level what it would look like. And then in order to come up with your cash flow for the month, you simply take your cash in, your sales, and you subtract your cash out. And so in this example, we can see that our cash flow for January was $1,000. So from here, we take our opening cash balance of $8,000. That was as of January 1. We add in our total cash flow for the month of January, and that brings us to our ending cash balance at January 31. So at January 31, we have $9,000 either sitting in our bank or likely sitting in the bank, but potentially also sitting, in cash. And so then from there, we take this ending balance and we put it to the opening balance of the next month. And you follow that exact same process. You go through your cash in, your cash out, you determine your cash flow for that month and add it to your opening balance. So it's just a process that continues throughout the year. And so in order to be effective, your cash flow projections should be updated at least monthly, if not weekly. So using your actual financial information, this way you kind of know the actions that you need to take or which expenses you need to monitor in order to ensure that your cash flow stays positive. So an example of this, I guess, would be in January, you've projected that your cash flow is going to be 1,000, but say you ended up with an additional 2,000 in sales. Well, then we should update these figures to show that the actual cash flow was $3,000, because that's going to help you for future months. So then you can plan a bit better for future months. So as I said, this chart, it shows a simple cash flow projection for the first 4 months of the year. And as you can see, some of the organization's expenses are fixed in nature. So these are expenses that are typically going to stay the same month to month. In this example, wages is usually a pretty consistent expense for the company, with slight variances here and there. If you have some hourly employees that, maybe in March, as you can see, they they didn't have as many hours, so you're down slightly. But for the most part, it's going to stay pretty consistent month to month. So those are your fixed costs. But then on the other hand, we have variable expenses. So materials is a good example. So as you can see, the amounts fluctuate month to month. So in order to kind of project these costs, you can use historical trends or current information available. So if you're at a seasonal business and you typically know that March or April is a very, very busy month for you, and you're typically purchasing a lot of materials, well, then obviously you're going to budget or project for more cash out in those months. And I guess another a quick example as well is if you know the cost of materials is going up, say you know in April it's going to go up, then reconsider the amount that you're going to be paying. A good example is COVID. COVID-19, a lot of different expenses have increased because the demand is so much higher. So if you know that the prices are going to be higher to buy your materials, we'll put that into your cash flow projection and try and budget for that so that you know it's coming. Okay. Okay, so next, it's really, really important to be realistic with your cash flow projections. So cash flow projections are only as strong as the numbers behind them. So it's really important to be realistic as possible when putting them together. So for example, being overly generous in your sales estimates can completely compromise the accuracy of the projection. So another example, if you provide customers with a 30-day payment schedule and the majority of your customers pay on the very, very last day possible, you should make sure you include that cycle in your projection and make sure you're really accurately reflecting your business. In terms of payables, it's important to try and anticipate annual and quarterly bills and plan for any increased expenses, like I had mentioned. Another important thing to consider is increased tax rates. So if you know that your business is likely to reach a new tax level, well, then you should incorporate that in your projections and make sure that you're budgeting for those extra increases. Another thing to consider is payroll. So watch for, if you're you pay bi-weekly, keep an eye out for months that have 3 cycles, because that's ultimately going to impact your cash flow for those months. And another idea is you can always put aside, put a small buffer aside, just in case something is missed or something unexpected comes up. I'm sure as many of you know, there's always unexpected expenses that you weren't planning for. So you can always have a little buffer for those expenses as well. So many of you may be asking, well, where do I start? How do I start a cash flow projection? So a good place to start would be using the company's annual operating budget. This is typically a good starting point because you can use it to identify each month's anticipated income, as well as the anticipated expenditures, and then kind of arrive at each month's expected cash flow. Okay, so how do we create an accurate cash flow projection? So the key factor to make your cash flow projection successful is to make it as accurate as possible. And I've kind of already touched on this, and you're only hurting yourself if you don't use what you actually think your business is going to make and what you think you're going to have as expenses. So some tips to make the most accurate cash flow projection include evaluating your business indicators. So when you plan and maintain your cash flow forecast, it's important to keep an eye on crucial business indicators. So a good example of this is did you find a new customer for a big deal that's going to generate all this cash flow? But you also have to consider, does this deal require any sort of investment in marketing, purchasing a new piece of equipment, investing in new staff to meet the demands of that client. So there's both sides you have to consider. So you really need to evaluate those business indicators. The second one is to predict your sales timeline. So it's important to evaluate when opportunities will arrive and generate cash for your business, and forecast such opportunities on a weekly or monthly basis. and put this into your cash flow projection. So, and another piece that's important to remember is just because you've closed a big deal and you have all this revenue, it does not mean that you actually have the cash in hand. So it could take weeks or months to get payment from the customer. And so until you actually have that cash in hand, your cash flow may suffer. So then up next, excuse me, so we have tightly hold your budget. So always keep in mind that your cash flow forecast should include a list of anticipated expenses and dates of getting paid. And this is where your accounting statements come into play. So that's the reason it's important to keep your accounting books organized in order to prepare for an effective cash flow forecast. And finally, I think we've already mentioned this a few times, but it's really important to maintain your cash flow forecast. So your forecast is essentially a document that is a living entity. It breathes. So it's important to make a habit of revising it on a regular basis and updating your forecast with the changing trends. Okay, so up next, we're going to just quickly go into cash flow shortages and cash flow surpluses. So unfortunately, we all hate to admit it, but unfortunately, cash flow shortages or deficits do occur. And a deficit arises when payments are due, but the cash balance is too low to meet those obligations. So it doesn't necessarily mean that the organization is running an overall deficit, but it simply means that at a specific time, the company does not have enough cash to pay its expenses. So I'm just going to flip back up to our example here. So as you can see in March, there was cash in of $8,000, but cash out of $9,000. So for the month of March, we had a cash deficit. We did not have enough cash to cover our expenses. But as you can see, we had opening money in our bank because we had cash surpluses in the other months. So that's the importance of trying to keep a positive surplus in your cash balance so that when you get to a month like March, where you don't have enough cash, you aren't in an overall deficit. You have enough money on hand to pay those expenses and get them covered, and doesn't put you into an overall deficit. Let's flip back here. So in the months with a cash flow shortage, it's really important to remember that there's certain expenses that you have to pay on time. So payroll is a good example of this. You have to pay your employees on a set date every 2 weeks, every week, however you pay your employees. So keep that in mind. You can't alter when payments are made to employees. Another example is payroll taxes. So your source deductions, you have to pay those on time. And another expense, insurance, for example, you have to pay those expenses on time. So how do you manage a cash flow shortage? There's several different ways, but as Jason mentioned earlier, one of the most common is to use a line of credit. So a line of credit essentially helps smooth over fluctuations in cash flow. And aside from closing costs when the line of credit is open, there's really no cost or interest assessment to your organization for having this line of credit unless you actually use the line of credit. So it's always a good idea to have one, a line of credit just sitting there waiting for you in case of a cash flow shortage. So of course, in addition to a line of credit, there are other ways to address a cash deficit. We could have short-term loans. So a number of banks will provide short-term loans intended to help companies cover operating expenses or cover certain capital purchases. Generally, these loans are for a short term, typically about 90 days or less. Another option is to try and speed up the collection of accounts receivable. This may be difficult, but sometimes you can reach out to customers and try and speed up payment. You could also liquidate investments. So if you have any investments on hand that you can easily liquidate to try and get your cash balance higher for that specific month. You can also try and cut expenses. So there may be expenses in your budget that could be deferred or cut completely. And it's important to keep an eye out for line items that continue to kind of outpace your budget. So an example of this would be, say you were wanting to do some repairs and maintenance to your office. These repairs and maintenance aren't needed right now, you could delay them, say, until the end of the year, or maybe even till next year. So those are kind of expenses that you can maybe defer or cut completely. And then finally, you can try to delay payments to vendors. So if you're really in a bind, you may want to consider negotiating with your vendors. So perhaps you have bills that are due within 30 days, but maybe they can be extended to 60 or 90 days. So explaining your situation honestly and requesting a revised payment schedule is much better than simply just not paying your bills. And again, just to reiterate, the expenses that you can ignore or shouldn't ignore are things like payroll and payroll taxes. These essentially will have to be your first priority. Okay, so then up next, of course, we have, or hope we have, cash flow surpluses. So this is when your income or your cash in exceeds your cash out. So it's important that you anticipate and plan how you'll manage your cash flow surpluses. So as I noted before in our example, as in January and February, we had cash flow surpluses. Well, that was great. And we planned ahead because we knew in March and April, we were going to have cash flow deficits. So it's really important to plan for those. And so if you do know you're going to have surpluses, you can anticipate it and manage it and come up with some ideas of how you want to use that surplus. So you could pay down debt. So you could pay off that line of credit that you drew on the prior month. You could pay off short-term debt or even make a lump sum payment on long-term debt. You can consider investing in your business. So this could be putting money into investments, investing in capital items, investing in new employees. The list goes on. And then another idea is purchasing. So use surpluses to buy supplies that you'll use over the course of the year at a reduced volume rate. So if your vendor offers you a discounted rate if you purchase a large number of items, well, then maybe you can take advantage of that discounted rate and buy a lot upfront and use it over the course of the year when you have that surplus cash. So with that, I am going to pass it back to Jason, and he's going to talk to you about what's next.
Thanks, Katie. So yeah, Katie's gone through the basics of the cash flow projection. I guess one of the things we didn't necessarily touch on is what the format is, and so I'll just kind of bring that up here. Generally speaking, cash flow projections are done on an Excel spreadsheet. They don't have to be overly fancy, and they're fairly easy to set up. That said, you can certainly get, there are apps out there that you can get so that you can be doing it on your phone or mobile. Most accounting software have modules for cash flow projecting. So whatever format works best for you. Everyone's got different personalities and different technological capabilities, but generally speaking, the most common that I've seen over my practice has been in an Excel spreadsheet. So what's next? You've built your cash flow, and that's a very important exercise. But what's next? And as we've kind of alluded to through this process, how you use it is really the important piece of cash flow projection. Make sure that you always keep your cash flow projection handy and refer to it when you need to make important business decisions. Ensure that you're and as mentioned a couple of times, make sure you're comparing your projections to what your actual results were. Chances are your first cash flow projection will end up being possibly close, but there will definitely be differences. Even if you've been doing cash flow projections for years, there's always unexpecteds that are going to kind of come in that are different than what you thought. And so use that experience, use what you've learned by those differences and try and kind of minimize those. And like I said, there's always going to be unexpecteds, but as you use your cash flow projection more and continue to maintain and update it, it will get over time more and more accurate. So another important item to note is to always be looking ahead. So as again, a lot of this is repetitive, but if you're projecting for a deficit, plan for it in the future, plan for it now. And as Katie mentioned, that can include cutting costs, possibly increasing sales or saving some surpluses that you have now for down the road. And it also provides a good projection of when the best time to invest in new equipment or hire new staff. So again, all of those pieces that Katie mentioned. And once you're in the habit of creating your cash flow projections, it does become a lot easier and it does become, as I mentioned, more accurate. So comparing your projections to actual results can help you improve the accuracy moving forward and really give you the insight to be able to predict long-term patterns and cycles. So in conclusion, cash flow forecasting is not always going to be easy. It's not always going to be the top of your list of what you like to do, but it is important. And it not only keeps you updated with what cash is available in your business, but it also allows you to understand what cash is needed and will be available in the future. And so that didn't run as long as the 50 minutes, but those are the basics. And I think the best time now will be to turn over and see if anyone here has any questions.